Hey guys, I'm going to do one of these special offer problems. It's in the book, chapter 23, Try It Problem, questions 7 and 8. The problem reads, Thomas Company makes a product that regularly sells for $12.50 per unit. The product has a variable manufacturing cost of $8.50 per unit and the fixed manufacturing cost of $2 per unit, based on $200,000 of total fixed costs at a current production of 100,000 units. Therefore, the total production cost is $10.50 per unit. Thomas Company receives an offer from Wesley Company to purchase 5,000 units for $9 each. Selling and administrative costs and future sales will not be affected by the sale, and Thomas does not expect any additional fixed costs. And they want us to answer, if Thomas Company has excess capacity, should it accept offer from Wesley? Show your calculations. And then, does your answer change if Thomas Company is operating at capacity? Why or why not? Okay, this is a pretty simple problem. Basically, we just have to compare what the operating income is, and more specifically the contribution margin is at normal operations versus what is the contribution margin at the special offer. So the first thing to do is make your little income statement. The contribution margin income statement has sales, variable cost, contribution margin, fixed cost, and then operating income. And then we'll fill that out for the normal operations and fill it out for the special offer. Compare the two, and if the special offer positively contributes to contribution margin, meaning that's a positive number, then we will accept the special offer. If it negatively affects contribution margin, then we will reject. So let's just fill out the income statement and then we'll go from there. So the sales under normal operations, it says, are $12.50 per unit. I'm going to just do this on a per unit basis. You can multiply out if you want to, but per unit keeps the numbers smaller and it'll work just the same. So $12.50 per unit for sales. Variable cost, it says variable manufacturing cost $8.50, and that will give us a contribution margin of $12.50 minus $8.50, $4 per unit. And then it says we have fixed manufacturing costs of $2 per unit, and that'll leave us with $2 of operating income per unit. Okay, so now under the special offer scenario, let's see what it says. They want to buy at a price of $9 per unit. Okay, and right away, just by looking at it, you would say, well, normal sales are $12.50, variable costs are $8.50, just the variable costs by themselves are $8.50, and then you add in the fixed cost, that's another $2, $8.50 plus $2.50, $10.50, given here in the problem, is more than $9. So just by looking at it without doing any analysis, you would say that's losing. Why would we do that? That doesn't make any sense. So just at first glance, you might just say reject, but that's why we have to do the analysis, plug the numbers in and see. Let's see if that turns out to be the case. $9 per unit, variable costs, let's see, variable costs $8.50 stay the same, because the more units you produce, the more variable costs you incur. and those are directly proportionate, so that's going to stay the same. And the contribution margin, $9 minus $8.50, 50 cents per unit. Okay. Now the key to this whole problem is, remember, you have to remember from previous chapters that fixed costs do not change. They're fixed in total. So no matter if we make 1 unit, we make 100 units, or we make, in this case, 100,000 units, or we make 100,000 plus the 5,000 special offer, our fixed costs are not going to change. So the light bill is going to be the same, or the rent, pardon me, the light bill might go up. The rent, which is fixed, it stays the same amount of rent regardless of how many units we produce. So our fixed costs are going to stay the same. So under the special cost scenario, the fixed costs are zero. We do not have any fixed costs under the special offer scenario because they didn't say we incur additional fixed costs, and the fixed costs are already accounted for under the normal operations. So in that case, our operating income is still the 50 cents. Is the same 50 cents from the contribution margin in the earlier in the special offer. So in this case, we can now look at it and say, under normal operations, we make $2 per unit of operating income, and under the special offer scenario, we make 50 cents. And that's principally because we do not incur the additional $2 of fixed cost under the special offer scenario. So should we accept the offer? Yes, we should accept. So I'll just write accept. Okay. Now, if you wanted to calculate the total amount of cost, that's the total amount that we're going to contribute, you can simply do the calculation like this. You take the 50 cents, so additional operating income for under the special scenario would be the 50 cents contribution margin for each unit times the number of units we're going to make, and they want us to make 5,000 units under the special offer, and that would equal 0.5 times 5,000, and that means we would make an additional $2,500 in operating income. So that's why we would accept it. It's positive 50 cents per unit. So that's an accept. Now, number 8 says, does your answer change if Thomas Company is operating at capacity? Why or why not? Okay, now that's assuming we don't have any extra capacity to produce this special offer. We don't have the machine hours, we don't have the labor, we are full to the max, we're selling everything at full price. And so you would say, well, if you're selling everything at full price, you probably wouldn't want to accept the special offer. So just intuitively you would say, no, don't accept. But how can we calculate and find out for sure? So the way you would do that is you would compare the contribution margin that you would get under normal operating circumstances versus the contribution margin you would get under the special offer. So if we were operating at full capacity, we would get $4 per unit but if we were doing the special offer, we would get 50 cents per unit. So that's a difference of $3.50 per unit. And if we did that, $3 $3.50 per unit times the 5,000 units, we would lose $17,500 because we're giving up $3.50 of contribution margin for every unit that we produce at a lower cost. If we're not operating at full capacity, we can go ahead and produce some units for, we can do the special offer. But if we're selling everything at full price, why would we give up $4 to get 50 cents? And that would be a $3.50 per unit loss. And that would total into a $17,500 loss. So number 8, the answer to number 8 is we would not accept the special offer if we're operating at full capacity, because we would be giving up $17,500 in operating income. So that's the solution to the try it problem, and I have the answer and you can find the answer at this address here. You can put that in your web browser and find the solution to the problem. They did it slightly differently than I did, but I'll show it to you so that way we can just compare. It says the answer to number 7, Thomas should accept the offer because operating income will increase by $2,500. That's what I have here, $2,500. And I got that by multiplying this 50 cents in additional contribution margin times the number of units, the 5,000 units right here, to get 2,500. Fixed costs do not change and therefore are not relevant. Right there we have 0. Fixed costs do not change and are not relevant. They should not be considered, so we're not considering that. And that's why I have a 0 there. And what they did was they just took the number of units times the revenue times the price to get the increase in revenue, and then the number of units times the variable cost, and then subtracted those to get the 2,500. But you could also do it the way I did it. I think it's more comfortable for me to make this income statement because we've done that multiple times in previous chapters and it comes out the same. However, you can also arrive at the answer doing it this way. And then number 8 is just as what I was saying. Thomas should not accept the offer if operating at capacity. To sell these 5,000 units at a reduced price of $9 means the company cannot sell them at the regular price of $12.50. That's reflected here in the contribution margin. Operating income would decrease if the order is accepted by the difference in revenues. $12.50 minus $9 times 5,000 unit is $17,500. $17,500 is what I got here. But what I did was I just took the contribution margin instead of the sales. So because the variable costs are the same, it wouldn't matter if you subtract contribution margin or if you subtracted sales. But for me, it made more sense to say contribution margin because that's what contributes to profit. So that's a $3.50 difference, and this is a $3.50 difference. So it doesn't really matter, and it still comes out to $17,500 difference in revenue. So that's the answer to the try it problem. Hope this helps on your final exam, and good luck, everybody.